pass it on to David. We never get it right. Pass it on to you, David.
Thanks, Zulema, and welcome everybody. We've changed the format as you've noticed in the last few calls from earlier, and so we can't see you. So I want to see you all in the chat, and those who've been on these kind of calls know that's often the liveliest part of these calls. And now it's starting to come in. So who you are, where you're coming from, and a little bit of what you're blending or how you're blending. So welcome everybody. There's so much talent among you all, and there's so much talent in the room here. I want to first bring in my co-host and colleague, Dennis Price. Hi, Dennis.
Hi, David. Good to be here.
And we'll introduce the guests in a second, but let's just give a little bit of a preamble. Blended finance, we've been covering it for several years now, and we've been very excited about it, and it has never quite arrived in the form or the scale that we and others have predicted. But now again, there does seem to be a moment or an inflection point in the size and the scale. We called this one blending billions, and they do seem to have now a lot of these deals have a B in front of them. What's different?
Well, I mean, we'll learn from our guests in a moment what they all think is different. Some of the things we're seeing that are just notable is, for example, private institutions initiating blended finance funds or taking the lead on the credit enhancement or the catalytic element of those funds, whereas in the past that was often the philanthropic and development groups. So that's one interesting feature. We're seeing fund twos, which we'll get into a bit later. So some sort of evidence of track record and demonstration of funds. You're seeing investors come in, into second funds, which is a good sign. And then with a number of the funds that we're seeing, it's these large funds pushing into sort of the frontiers of impact. So we'll see sort of gender elements. Where markets are failing, adaptation versus more established mitigation elements, and then funds going into lower income countries. So commercial investors taking on a bit more risk, those funds themselves then taking on risk. But I think whether we hit that inflection point, we'll see, and super curious what the guests will share with us. So,
well, great. That's a good time to bring folks in, and let's welcome our esteemed panel here. Rajashree Padmanabhi, excuse me if I messed that up, from Climate Fund Managers. Welcome. Are you?
Hi, David and Dennis. Thank you so much for having me here. I'm really excited to be here with Debra, Ariane, Nnamdi. They're all great panelists to be with, and I'm excited for the conversation.
And where are you coming to us from?
So I'm joining this from Netherlands. So Climate Fund Managers is based in The Hague in the Netherlands.
Great.
And it's a beautiful sunny day, probably one of the last summer days in Netherlands. Yeah.
Nice.
So I'm really excited.
Nice. Well, welcome. And Ariane Pevide, welcome from Mitsubishi UFJ.
Hello, everyone. Good morning, good afternoon. Joining from London, not the same luck with the weather. So thank you very much for the invitation. Already with the starting remarks already gives a lot of talking points that I'm very happy that I get the opportunity to share today. So thank you very much.
Great. Well, we're eager to dig in. And Nnamdi Igbokwe from Convergence, our old friends, and a super useful resource and information for all of us here.
Hi, David. Welcome. Yeah, thank you. Hi, David. Hi, everyone. Great to be here and join the panel. Joining from New York by way of Toronto, where Convergence is headquartered, but currently I'm in New York. So good to be here today.
They've got you in that remote outpost there. So.
Exactly.
And our old friend Debra Schwartz from the MacArthur Foundation. Debra, welcome.
Thanks, David. It's great to be here with the team from Impact Alpha, and thank you for all the coverage that you do, not only blended finance, but the whole spectrum of impact investing, from catalytic to everything else. And lovely to be joined with friends from different corners of the blended finance world. And I'm coming from Chicago, and we're also having the most gorgeous weather ever. And it just makes me almost want to cry, because I just know it's not going to last. It is so beautiful outside.
Well, we'll let you get back outside in a little bit, Debra. But thank you for joining us.
Okay.
And I also want to give a special shout out. Debra's been a mainstay and an instigator of something called the Catalytic Capital Consortium, or C3, which also includes the Rockefeller Foundation and the Omidyar Network. And C3 is a partner and has been for many years of Impact Alpha in helping us stir up this whole catalytic capital coverage. And so effectively, this call is in some sense brought to you by C3. So thank you, Debra.
Well, and Convergence is another amazing C3 partner. And there's probably, I see so many friends and leaders on the chat. It's just amazing to see who's on this call. Hello to everyone. You've
really cultivated and curated an incredible network that's come together around all of these things. And let's just start with you, Debra. I always think of a line that you shared with me many years ago. Markets may not be perfect, but they are not stupid. And you've been trying to solve for some of the, I guess, market failures, or at least market gaps, for many years, and have some good tools in your toolkit. But start us out with what are the problems what's the problem that we're trying to solve here? What is blended finance and broadly speaking at Catalytic Capital try to overcome?
Thank you. I do want to put one other piece onto that very quippy, memorable statement that we exchanged a while back. The markets can be incredibly biased. They can be discriminatory, they can be abusive, they can be prejudiced. So I am not painting things in a gilded fashion. But I do think, as a general rule of thumb, as impact investors who try to play this additionality role, or a but-for role, as we do at MacArthur and many others that are on the chat today and around the world, you start with the problem. Our mantra is problem first, tool second. You don't know what kind of financing. Is it debt? Is it equity? Is it guaranteed? Is it blended? Is it not? Is it venture? You don't know till you know what the problem is that you're trying to solve. So that I stand by 1,000%. And then as you identify the gaps, is it because companies in the sector you're working in are too early stage? They're just risky because they're early stage, or is it because they're subscale and so their economics don't deliver the kinds of returns that you might want to see? Is it that they are in countries that have a lot of political risk and currency risk and things like that can make it very difficult for investors? Or at the dawn of impact investing 50 years ago, is it because the community was redlined, literally, legally, by policy, redlined, so that there has been no market activity for decades? And so how is an investor who is even motivated supposed to go about that lending, to homeowners, to small businesses? There's no data to look at, because literally nothing to look at. So these are the kinds of gaps we see. And then we try to figure out, how do we jumpstart? How do we bridge? How do we create market activity where there hasn't been any? And I see CDFIs, showing up in the chat. I will just say that I think our first blended finance deal was in Chicago in 2003, with the transformation of public housing that had been deeply, profoundly segregated and cut off from the city. And there was this effort to build mixed income communities, but how to get lenders to lend to market rate homeowners in places that had been really blighted and mistreated and deprived of resources. And so we used a guarantee for the first time in 2003 to bring in a pension fund and to bring in Fannie Mae. And this is 2003, so this is several years before it got subsumed under conservatorship. And we created a pool of capital to finance some of that redevelopment, because we knew that we needed to jumpstart, and that in time there would be sales and there would be property taxes, and then other investors could come in. So blended finance is a form of bridging gaps where you layering different types of risks and rewards. The SDG Loan Fund, which is what we'll talk about today, is probably one of I haven't counted up properly, but about a dozen that we've done that were blended finance, but we didn't have that term. Convergence didn't exist when we started. It's a little bit like the catalytic capital story, right? We were all doing these things, but we didn't have the language. So we did most of the blended finance work in the United States in the context of housing activity that we supported. The SDG Loan Fund is part of our catalytic capital portfolio, and it is a $1.1 billion vehicle. To a point that Dennis made, the leaders in creating it are Allianz Global Investors, institutional grade asset manager, and FMO Investment Management, which is the investment asset management arm of a leading development bank in the Netherlands. So the two of them created the idea for this. And what we've ended up with is a structure where we have multiple institutional investors, insurance companies and pension funds, supported by a first loss investment from the development bank, supported by a guarantee from a private foundation.
Well, let's pull that apart, but I want to just underline that I think, if I understand, Allianz, the idea started from the institutional investor who wanted to find a way to support things like the Sustainable Development Goals, and then said, well, how am I going to get this through my investment committee and to conform with my risk profile? And so it didn't start from the impact folks saying, how are we going to go find some institutional investors? It started from an institutional investor. How can I make the deal work?
Well, it started from many places. And as with a lot of things, the timing turned out to be right. So AGI had already done work with IFC. FMO had created their investment management arm a while before and had been doing different things to mobilize private capital. It wasn't the first time that they thought about it. And we, as I said, have been doing blended finance in a different context for 20 years, but we had decided to do this global initiative, and we fanned out and talked to hundreds of people, many of them on this call, to say, where are there powerful demonstrations of catalytic capital? Because that's what we're looking for. We're agnostic on sector, we're agnostic on geography. Very weird in the philanthropic world, because what we want are the most interesting collection of demonstrations, and the most powerful demonstrations, some big, some small, some with entrepreneurship and venture, and some of them around real estate, and this one around emerging markets, where institutions have wanted to put money behind the SDGs, but need investment grade quality opportunities to do it at scale.
So let's just understand, why couldn't, like, just in a different world, why couldn't Allianz have said, oh, we want to support loans for small business and development and whatnot in emerging markets or low-income countries? Why couldn't they have just done that on their own? Why was that so risky?
They had done some, and they'd done the partnership with IFC, and other institutions are doing it. And I think, Nnamdi, you probably have more of the data about the sort of big picture. But the basic issue is that there are regulations, and in particular capital requirements. So if they start doing investments in non-investment grade opportunities at scale, like this, $1 billion, let's say, that starts to generate all sorts of challenges internally for those investors and with their regulators, because they're changing the risk profile, if you will, of their portfolios. And that isn't the only reason, but it's a very big reason. And so we needed to create something with this fund, what we were aiming to do, that it would have investment grade quality, so that not only Allianz, but other institutional investors would be able to participate in it at a relatively large scale, because a lot of the opportunities before had not met that. Now, I don't want to pretend that $1 billion solves the SDG funding gap. I mean, we all understand that's trillions. But what we did think we could do is be big enough to matter, to make people look at it and say, wait a second, how'd they do that? And begin to think about the pieces of the approach, not, in a cookie cutter way, but to think about how those pieces could be adapted and applied in other settings.
Well, just help us understand now those pieces, because there's a bunch of terms that come around, and I'm not sure people understand the distinctions of them. So FMOs was a first loss reserve, and that
FMO is playing two roles. So they're playing a first loss role, the kind of true catalytic piece, by buying a little over 100 million. 10% of the capital is FMO in Class B shares that take a higher level of risk. And that piece then is what required our guarantee for some highly
hold
technical
on that for
reasons.
a second, just so people understand. It's super basic. First loss means if some of those loans go bad in some of those markets, then
they get hit first.
That will go to FMO first, not to Allianz.
Correct. They don't get their returns until you start to see
got it.
Performance for the A shares. But the other thing, so that's FMO, the bank, a regulated bank. But the other thing they're doing, and equally vital, and maybe the most notable innovation of all, is that they had this separate but affiliated asset management entity, FMO Investment Management, or IM, and they created it to be able to help other private investors, invest by buying participations in their loans that they were making in the due course of doing their 50 years of development finance work in low, moderate income developing countries. And FMOIM has a very specific role in this transaction, and that is portfolio manager. So the way the fund is originating loans out into the target markets across the 3 target sectors of financial inclusion, energy, and agribusiness. And for those of you who are SDG fans, 8, 10, and 13 are the main goals. There are other goals that are served. And the way that's happening is that the fund, SDG Loan Fund, is buying participations in loans that are originated by FMO. And this effectively allows FMO to do more than it could with its own capital alone. So those are its 2 roles: first loss investor, portfolio manager.
Got it. And then FMO has its own investment policy that it has to meet. And so MacArthur came in with a different form of catalytic capital, of a guarantee. And so how does that work?
The biggest issue is actually more to do with accounting rules, international accounting rules. And without my colleague from FMO, I'm not going to try to lay out chapter and verse. But I would just say, because they were playing the 2 roles simultaneously, one of the big issues was, were the loan participations that were being sold, were they sufficiently distant so that it didn't affect the variability of FMO's asset base? But it was, again, an issue of accounting and regulation and very, very wonky technical things. And some of those factors kind of unfolded as we were working on the transaction. So, this is one of the things people note about blended finance, is it can take a while to put the deals together. And I think what you have to bear in mind is that what we had at its core was a transaction with institutions based in 3 different jurisdictions, a fund that was domiciled in Luxembourg, so that's a 4th jurisdiction, and each of those places and sectors, philanthropy, asset management, development finance, has various regulatory frameworks that they live between. And so part of what you're trying to do is puzzle out a structure that's going to work for everyone. It's going to work for the beneficiaries on the ground, first and foremost. Is it going to get useful capital to those places? Because it doesn't matter if you get capital there and it's like so expensive and so constrained. So is it going to get useful capital to those who need it, where you're trying to make an incremental difference? And is it going to work for the institutions in each of their situations with their stakeholders? And so that's what you're puzzling over. And that's why the catalytic capital, I think, always kind of, even though it's small, can end up being important, because it can kind of fill a gap, as we were saying earlier.
And you've said, I think, if you take the 25 million to the 1-point-something billion, that's like a 40-to-1 ratio, and pretty good leverage. But it's even better than that, I think, because if that guarantee never gets called, then you actually haven't actually put out any real cash, and in fact you've incented this other money to come into the market with just a sort of a stake of a sense that you might know something about the risk perceptions that the market hasn't yet figured out, and then we're off and running, right? So the 25 million doesn't go out the door unless it gets called, right?
Yeah, we've done about 7 or 8 investments with guarantees specifically, and then we've done other blended structures where we're just in a subordinated position, like the New York Housing Fund, and there were 7 foundations in that transaction back in 2005. Some of the guarantees are set up in ways where they're almost sure to get called. We did a fund around home mortgages in the wake of the subprime crisis, and it was part of just keeping neighborhoods in a position to put people back in houses as that became possible. So some of those were structurally just inevitably going to get called. We didn't know how much, so that's why you don't do a grant, because you don't know how big that number is going to be. We've had some where we set it up where if the guarantee got called, it turned into a different kind of instrument, like a cash flow loan, and would potentially get paid back to us. And then we have some we did with the National Affordable Housing Trust and Mass Mutual back in the wake of the subprime crisis. We did a $20 million guarantee, mobilized $300 million in equity investment. And that is about to mature, I think, in another year, 18 months. And it's never had a call, and it mobilized a whole bunch of debt on top of the equity, and it sparked replication. And that's a nice deal.
That's a nice deal. I think everybody can understand why when anybody wants to do a blended finance or catalytic capital transaction, they come to Debra Schwartz for advice and guidance. And so Debra, let's stick around and thank you. But Dennis, you've been covering the climate investor too. So why don't you bring in Rajashree?
Yeah. Fantastic. Thanks, Debra. Rajashree, so Climate Investor, Climate Fund Managers now has 2 blended finance funds in the market. Can you give us a bit of the history around Climate Investor 1, which is the first, and sort of the status of the new fund?
Yes, of course. So Climate Fund Managers, as I said, is a blended finance fund manager based out of Netherlands. And we started back in 2017 with our first fund, Climate Investor 1. It closed in 2019 with around $850 million. And since then, we have almost deployed all of the capital. And then during the course of this work, we realized that there is a much larger need for blended finance in adaptation sector. So then we launched a second fund for adaptation called Climate Investor 2. No points for guessing the name there. So Climate Investor 2, we had the third close in 2023, end of 2023, with around 175 million. And we are still fundraising and aiming to close at around 1 billion by March 2025. So that's where we are at in the fundraising journey for CI2. And even that fund has already started deploying funds in emerging markets and infrastructure. So for both these funds, basically the 2 fundamental blocks are we invest in infrastructure investments only, and we invest only in emerging markets. So that we think that the real economy impact of climate change, both mitigation and adaptation, is the most important thing. So infrastructure is the way to do it. And it should be done in emerging markets because that's where the most need right now is. And that's where blended finance can really make a dent. So so that has been constant, but one is strongly focused on mitigation and the second one is strongly focused on adaptation.
Before we come to the really interesting catalytic elements of the structure in the fund, can you just give a couple examples of the different types of investments that fall into the sort of mitigation category, and now what you're focused on in Fund 2 around adaptation?
Yes, of course. So in Climate Investor 1, it was all renewable energy mostly, so solar, wind, and small hydro. Those were the sectors that we focused in. And now in adaptation, we're doing water, sanitation, and oceans. So those sectors, I think, have the maximum adaptation benefits and also have interesting investment opportunities.
I can't resist jumping in here. One of the ones that's fascinating is the Galapagos debt for climate deal. Can you just briefly outline that? Because I think that'll get folks excited.
Yes, of course. So it falls in the third bucket that I just mentioned of ocean and marine protection. It is one of the largest debt for climate swaps that's being done in the Galapagos Island. And I can explain a bit more about the structure, but it's basically the blended finance structure and the potential of public capital to provide these, risk-free, or in terms of, I would say, just like patient capital to do the kind of due diligence, feasibility studies, technical studies, and all the conservation impact assessment that was needed for that fund. It's literally the role of that patient capital that deal was possible. Yeah, I think there is no doubt about that.
And in both funds, you've been able to attract institutions and private capital. Can you tell us a bit about the fund structure and specifically some of the catalytic elements?
Yes. So as Debra also mentioned, one of the main catalytic nature of our fund is the first loss capital. So in both the funds, the way we have structured them is that there's public capital that comes in either as donors or grant or as first loss capital. And then there is mezzanine equity and senior equity that comes as from private investors. So I don't want to put in big words there, but basically just concessional low return capital from public investors and a little more profit-oriented investment from commercial investors. So those are the two pools, right? So in the catalytic nature, when this investment comes in, it I would say benefit in 4 ways. One is subjectively, it brings credibility and investor confidence from commercial investors that there is been enough due diligence, there is a sense of confidence that this fund will work. And objectively, I can say that there are probably three benefits. One is that all this grant money can be used for project preparation. So because we do infrastructure investments, there is a lot of background work that needs to happen, right? In terms of, say, environmental and social impact assessment, technical studies. It's not really easy to build these solar plants and wind farms. It's a very technically engineering heavy work. So a lot of work goes into that project preparation. So the grant and donor money helps us develop that project with project preparation. And then the first loss capital sort of helps in downside protection. So if it is ultimately a risky business when you're investing, not just in emerging markets, in anywhere. So the first loss capital helps in downside protection and also helps to boost a bit of investment return because they are taking concessional returns. So some leveling effect happens and then the commercial investors can get a little higher investment if that works. So there are like 3 different objectively quantifiable returns that commercial investors get.
And we like to focus on how these funds are structured and come together, but there's also what's unique about some of these blended funds is what you're then able to deploy the capital to. And can you share a bit about how having those multiple types of capital involved allow you to invest, for example, like throughout the cycle of some of these projects, the life cycle?
Yes, definitely, because I think that's also one of the unique structures of CI1 and CI2 that we provide funding throughout the life cycle of the project. So like I said, the project preparation facility is basically a sub fund within the CI2, which is called a development fund, which gives out returnable grants of the order of about 2 million for each project. And they are helped to prepare the project and make it investable. And then that project graduates into something called a construction equity fund, which basically provides funding for taking care of the construction risk and developing the project and making sure that it reaches the operations. So for like a solar, it will be doing all the project preparation, constructing that project and making sure that it's operational with the right PPAs and all the end users in mind. So that is how we provide the entire whole life cycle financing. And in the construction equity fund, then there are 3 different tiers for junior equity, mezzanine equity, and senior equity. So for junior equity is, as I said, public capital, which is first class. Tier 2, which is mezzanine, is the actual institutional investors that we're talking about here. So they are the pension funds, they are the foundations who might be wanting returns. So they are the commercial investors with return expectations. And then there's tier 3, which is again low risk commercial capital on the back of a guarantee. So that commercial equity fund is basically also helping meet the construction risk requirements of a project and making sure that it reaches operations. And then the refinancing is easy, right? Because the project is operational, and then there is always buyer when a project is operational. So then that takes care of itself.
That's beautiful. So you're blending both at the fund level and also at the venture and initiative level. So thank you. And I imagine I don't know whether you two could collaborate, but I know there seems to be some parallels. Ariane, take yourself off mute while I bring you in here. Because the Gaia Fund also is working on climate and also in low income countries. And why don't you just give us the basic brief on how you've blended that, Ariane?
Yes, and it's good to have Rajashree because Gaia, the asset manager of Gaia is CFM. So we're all in house. We're all in family. We're all we're all friends and family. But and thank you very much for the opportunity. But taking one step back, exactly of the ecosystem is one important thing to note is that Gaia is really the personification. And I think the point you made at the beginning about the hiccups that blended finance have had in the past and how can we make it, how can we really streamline the billions that we need to get to the trillions. I think one of the things that happened for MUFG and that is so critical for our role in sponsoring Gaia with all of our partners is the acceptance and incorporation of blended finance as a product. And I have Convergence here, who has the best definition. Blended finance is not an asset class, it's a structuring approach. But for us to make sure that we can change the mindset of normal corporate and investment bank into what blended finance is needed was key. And Gaia was exactly what was the turning point for us. And now I think as more banks are doing, we're the first that we're really setting up blended finance as a product office of MUFG. So really together with capital markets, equity derivatives, you have a blended finance office that can really make this part of our DNA and strategy. So about Gaia, so without further ado, so Gaia is a $1.5 billion fund, blended finance fund focusing in climate adaptation. And as Debra had mentioned, we started from the problem, which was how can you move and mobilize large quantities of private capital into climate adaptation in vulnerable countries. And us being a bank, debt is our instrument of expertise, the expertise we had. So working with some of the issues, and our sponsors are the sponsors of Gaia's MUFG, FinDev, and CFM. So also working with FinDev Canada as a DFI, what was important for them. So we then try to find ourselves in the middle of what we can do. So that's how the structure of Gaia has come about. So very similar to what has been mentioned on the SDG fund and on CI1, CI2, we have a first loss layer, which will take the hits in case of if the loans don't go well. That represents 21% of the capital of the fund. and you have 79% of senior investors, which are the commercial investors. On top of that, we have added a facility of guarantees and insurance for the investors who require additional protection. And we've created the flexibility that the investor can determine if they need additional unfunded insurance and guarantee, because that carries a premium. And it's for the commercial investor to decide if they want to be with just the 21% protection and have a higher absolute return, or if they would prefer to pay the premium but have a higher protection. And then we can adapt the risk return profile depending on that investor at the time that they join the fund. And it's interesting to see. I think that the case of MacArthur Foundation, it really set an amazing example of having the philanthropic capital being so innovative that I think it forced the MDBs to follow suit. So we're seeing with the reforms of the MDBs being more innovative with guarantees and insurance products that they hadn't done so far. So I think that was a great halo signaling effect from the foundations on that work. So well done to Debra for setting that in motion.
Just on that, because in this case, the guarantee is set up by AXA, an insurance company, but it sounds like they get paid for that guarantee as well.
Yes, they will pay. They are paid their premium for the insurance. But funnily enough, and then so Guy has been in the works for the past 2.5 years. We had to get the GCF money. That is in itself a Herculean task. And now what we've seen, we are in discussion with MDBs and with other public sector entities that would be interested in providing guarantees as well. So this is a great shift we've seen recently, and I think it's we know in the private sector we love to complain about the MDBs and the DFIs, but kudos for them that they've been really trying to change the way they operate. And I think de-risking mechanisms as guarantees can be very catalytical with less capital allocation.
And just so everybody understands, GCF, Green Climate Fund.
Climate Fund, yes.
MDB, Multilateral Development Bank. DFI, Development
Financial Institutions, yes. And
you go, David. That's good.
And one of the things that's in this that I think is also important is a foreign exchange hedging mechanism, because that's obviously one of the risks that people always mention.
Yes, and that's exactly when we joke that blended finance can be everything. You can have any financial instrument blended, from debt, equity, and also FX. So with through a grant funded by Global Affairs Canada via FinDev Canada, we have grants that cover the cost of hedging. So Gaia is able to offer a local currency loan to its borrowers without any risk of foreign exchange. We partner with MFX as the hedge provider, and the cost of the hedge is borne out of this grant account.
And just to be clear, like who the players are, Mitsubishi wanted to put this deal together, and then, as we said in the case of the SDG Loan Fund as well, had to kind of make it work in your own criteria and parameters. And so you went looking for partners to work with that could get this through your own investment committee.
Yes, and that was it was really FinDev MUFG at the same time in the co-creation of that movement of our senior management trying to think how to move into that area. And then we set out the criterias and the main issues that we had from our institutional perspective. So what are the things that we really need to have in the structure to make it work for us? And in the case of MFG, it had to be a fund that did debt. We are not an equity house, so it had to match with our DNA. In the case of FinDev, as them being a development financial institution, they also were interested in the impact and how could their capital be catalytic more than just providing first loss. And that's where we have the FX facility and also a technical assistance facility to make sure that the projects are supported to get to financial close. We all know that lack of technical assistance is a big hurdle for the projects to reach a bankable stage. And for us, but this is exactly, we start from the mindset of what we're trying to solve and also what I need to solve. And then what will the market need? Because we'll still fundraise. So we're reaching financial first close this year, but we still have to fundraise. So we had to be mindful that this will also have to fit a number of other institutional investors out there.
And you're finding institutional interest in this because of all these elements that you've.
Yes,
yeah.
and one clear point is when you're doing things that are proof of concept. So for instance, climate adaptation, it's quite important to get something done in deploying capital so that people can understand how your portfolio will work, what are the type of deals. That's really the strategy we take. And you need to start putting money to work so that a lot of the more conservative capital have an ongoing concern to make the case for their investment committees.
Great. And final question. I know you've pledged to align with what's called the 2X criteria on gender inclusion, and we've been very keen on gender lens investing for a number of years. Why make that commitment?
So that was one of the points that when we were discussing with FinDev Canada, as one of our co-creators, FinDev has a big focus in gender. And then that was one of their points that said, besides just doing climate adaptation, we can add the gender lenses to this, especially through the technical assistance facility, that we then can have grant money to help the projects apply the lenses of gender in their project development. Because that currently we don't see that there is a lack of willing of being gender positive and at the project level. It's just that it costs money and they don't have that capacity. So the fact that we can offer that through the technical assistance was what allowed us to make this commitment.
Great. Well, thank you, Ariane. And let's switch to Nnamdi. And I imagine some of this is music to your ears in the sense of all the people jumping into the world that Convergence has been in for some time. I just want to bring out one thing that seems to be coming. Both FinDev Canada and FMO and other players taking on a kind of more catalytic role than they may have had in the past. The so-called development finance institutions now sort of seeing their role as helping bring other players together, as well as just being investors themselves. But give us the lay of the land here. Why are we at the fabled inflection point?
Yeah, thank you for the question, David, and thank you for going sort of behind the curtain to Rajashree, Debra, and Ariane and all these deals. So the question you asked is an important one. I can't get so granular here, but I will say that make sure you join Convergence at the end of October, where we'll launch our State of Blended Finance Climate Edition, which will really get the trends and what's going on in the marketplace. But I'll say this much: it's been a challenging few years. If we think about COVID, if we think about the other macroeconomic pressures and exogenous shocks that have sort of redirected finance and investment landscapes, and blended finance volumes dropped during that period. In the last year, however, it's rebounded strongly. So we've reached a 5-year high of 15 billion in deal volume. So big picture, things are certainly moving in the right direction. 2023 saw a surge in deals over 100 million. Typically, those deals represent around 20-25% of our deal volume, and we saw it reach 40%. The cadence of deals increased, whereby you see more deals on average per year. And climate blended finance space saw volumes more than double in 2023. So the market is definitely growing. It remains uneven. It's important to point out that certain sectors are still nascent. You think about health, you think about education. Other sectors like agriculture have potential, but are still underperforming. Regional disparities exist. A lot of blended finance flows are going to sub-Saharan Africa and Southeast Asia, but there are opportunities in other parts of the globe. So overall, we're seeing positive momentum, and I think I agree. Arguably, I think we're in the midst of a very punctuated moment where we're going towards scale, where we actually see the needle moving when we think about these larger deals. And as this forum is aptly called blending billions, I think we are in the midst of just exactly that.
How much of the market are comprised of these billion-dollar funds? Are we seeing more of those, or are they still a relatively small part of the market?
So big picture, they're relatively small. Probably less than 5% of all deals in our database reach that $1 billion mark. But I will say that although historically they haven't been common, in recent practice, we can clearly see that they can and should be, right? So conceptually, the market has always looked at some of these deals as one-offs, right, or unicorns, never to be seen again. And I think this year and the last maybe 16 months or so has proven that that's not necessarily the case. I'm going to borrow a phrase from our CEO, Joan Larea, who put it this way. After having watched the blended finance horizon for a single tail fin that would signal change, we suddenly are seeing an entire pod of whales breach the surface. So these whales are these billion-dollar deals, which are no longer one-offs, are coming to be more common, more typical, and having investors see that these levels of scale can actually be reached.
Of the we've heard first loss mechanisms mentioned multiple times here, as well as guarantees. Are there tools that are emerging as more effective in catalyzing private capital? I know all blended deals don't necessarily have a catalytic element, for example, but of the ones that do, are some of these tools more effective? Are they more attractive to certain types of investors? What do we know about the actual tools?
Yeah, so in terms of effective or attractive, I think it's case by case. I really enjoy the methodology that's being put forward here, where you're using blended finance sort of as an examination tool where, does it fit this purpose, as opposed to just a blanket solution. It's, does blending come into place? So I think that's a really important step. But if we think about the specific archetypes is what we call them, but the functions of concessional debt or guarantees, we've always seen concessional debt and equity sort of lead the charge. Around 50% of total financing is in this space, and it's a common trait across large deals. So if we want to group these bigger deals together and just see what's common amongst them, that might be a good way to think about it, as opposed to more attractive, less attractive. So they tend to involve concessional debt and equity. They tend to involve diversified funding structures, meaning you have multiple players that are involved. If we look at the SDG loan fund, for example, you see that you have an NBB, DFI, you can see that you have philanthropic capital, you see where the private investor comes in, you see this mix where, as we were calling it, it's a first loss to a first loss, so to speak. So this sort of diversified structure tends to be seen with these larger deals. And as far as one aligning factor, climate, sector-wise, there's unquestioned alignment around climate. If we think about energy and other areas of climate, investors have become very comfortable with just these standardized business practices and understanding those business models. It's still incumbent on us to kind of provide those cases for adaptation and others, but climate tends to be across the board sort of the moving factor in terms of the sector that we're looking at. So those characteristics are shared amongst the larger billion-dollar deals. So we can call those more effective, so to speak, but practically, I would say going about looking and assessing and evaluating deal by deal is more meaningful and impactful. But if we want to try and align and see where characteristics sort of are similar, those few things are consistent amongst these larger deals.
Let's open this up, and Nnamdi, you can take a crack at this, but everybody else can chime in as well, which is, and this question is coming up, I think, in various forms in the chat, which is, how do you know the right level of subsidy to put in? Another way to say it is, are there markets where catalytic capital was required, but now that the risks and the track record is more well known, it's no longer required, and so is there kind of a glide path to just having commercial deals in some of these areas? So how do you calibrate sort of the level of subsidy?
Yeah, it's a really hard question to answer. If we think about just transparency with data alone, it becomes very, very difficult to know what that subsidy point is. But the point you're raising is one that we've been grappling with in the ecosystem of blended finance, and that's like, what does this off ramp look like? What is this sort of after effect? If we look to clean energy, let's say, initially there was a lot of blending going on, there was a lot of catalytic capital going pumped in to that sector, but after some time, we see deals that are being done without necessarily a tranche of concessional capital or a guarantee. And is that because blended finance has shown that you can price risk this way, you can assess risk this way, and now we understand that this sector at least can operate on a private commercial level without necessarily the same level of concessional capital or balancing the risk and return. It's hard to quantify, it's hard to pinpoint and draw a line and say it once was here, it is now here, and therefore it's had this effect. But I think we can at least notionally agree that there is a way that blended finance should not be needed, across the range of investing for a long term. It's not the intended design. It's not supposed to be a mainstay. It's supposed to be a tool that is used and hopefully no longer used as the market adapts.
Right. Do others want to
Yeah.
jump in? Yeah, Deborah.
Yeah, I mean, I think it is a critical question. The flip side of over subsidy is how do you find smart subsidy? What does that look like? And that doesn't just apply to blended finance, that applies to anyone doing program-related investments in historically marginalized communities and doing really higher risk, early stage, seed stage investing. It's a question for all impact investors. It is more art than science, and I know we don't like that answer, but as Nnamdi said, it's a combination of data, transparency, is a lot of reasons. I would just say this, one thing we thought was quite important about the SDG loan fund was we were able to do it with a 10% level of first loss. And we know that we have seen levels, 20% would be quite common. We were in transactions many times before that had more of a 20% level of first loss. And we've seen some that are even higher than that. And I think when you start edging up, it's all market specific, it's geography specific, so we can't make generalizations. But when you start seeing 40, 50% ratios, that's a moment when you start to really wonder what is exactly going on here and why does it look like that? I'm not saying that, we know categorically that that's tipping over the edge, but I think if you're in that 10 to 20% range, it at least aligns. And Nnamdi, you could confirm this, but I think that aligns with what we have seen mostly. Again, there's no scientific theory sitting underneath it. As a person who has been putting these deals together for most of my career, I think you can tell when you are pushing a private investor or a public sector partner to do some things that they don't normally do. And that's the whole point, right? Is to bridge the gap, you're trying to push the investing envelope. And so if they're doing the same thing they would have done anyway, then I don't care what level of first loss is, it's not smart. Are you getting something additional out of this?
Right. And to sort of the flip side of that is, maybe Ariane, the Mitsubishi example, would the next deal require less?
No, that's exactly, and I always joke that blended finance is meant to be the little wheel on the bike when you're learning how to ride a bike, and it's supposed to fall away, and that you can then do it on your own. And I think that in our case, more than just the jurisdictions that Gaia is targeting, it's the concept of long-term lending into climate adaptation, working with sub-sovereigns, things that just mainstream commercial banks are not used to. And one point I would take on the level of subsidy that is the right one, like how do we minimize concessionality and maximize impact? One thing that is also need to take in consideration is the overall market situation. I think that when the rates in like a year and a half ago, when the overall interest rate market really changed and rates became much higher, then you see a change where investors can find more traditional, less risky investments rather than take the long road of going into a blended finance fund. So I think those things also need to take into consideration, especially when you're fundraising, because then you are competing with things that are not comparable in terms of impact or structure. But generally, since blended finance in most asset managers, large investors are not an asset class, you end up competing with things that are nowhere close with the same impact, but provide a more comfortable risk return rate to the investor. So that also then impacts how much of protection, concessional capital you have to move those investors. So it's always a balancing act from the perspective of the blended finance practitioners.
And that seems to be like that would make the recent uptick in blended finance transaction totals even more remarkable in that environment. Maybe that environment changed the other day, but we'll see. It seems like one of the things that's changed, and Nnamdi, I think the numbers bear this out, bigger deals, right? And so now that becomes itself one of the things that institutional investors can more easily get their heads around. They want to write bigger checks, and now some of these deals have become big enough to attract it. So maybe there is a bit of a snowball effect as the deals get larger and the structures get more well established.
Hey, David, Rajashree had her hand up a second ago. I just want to make sure you saw that.
Maybe take a whack at that, Rajashree.
I'm curious too, between Fund 1 and Fund 2, was there a change in the level of subsidy or change in the structure?
So not a direct change in the structure because the investment strategy itself entirely changed, right? So mitigation, though it is as we know that it is fairly commercial in several parts of the world, there are of course still areas where it is a high risk business. So for example, one of the transactions we did was a wind farm in Djibouti, which is the first wind farm in Djibouti, and it's been incredible experience to work on it, and we have a very talented and dedicated regional team that has put that together. So as Ariane also mentioned, the market conditions and the context of geography and the technology, it all plays a very big role in what that level of subsidy should be. It's not, as Debra said, it's not a cookie cutter solution for sure, and it depends on the context of it. But eventually we do want to move to a lesser hand-holding for sure.
I've had a hard time keeping up with the chat and the Q&A, and we're running up to the hour here. So I think we're not going to be able to get to all of that. We will try, of course, in our coverage to cover it all as time goes by, and we'll also round this up in a post for Friday and tomorrow actually. And some people have asked whether the video will be available, and we'll embed that in the post, and that'll be up on YouTube as well, so you can pass that around. Zulema did me the service of reminding everybody, if you are a subscriber, thank you very much. If you're not a subscriber, we have this free open weekly, and that gives you a little taste of what we do. And it's just go to impactalpha.com/open and sign up for that, and we'll keep you in the loop. We used to have a kind of after hours party to these things, but now that we can't see you all, it's a little hard to hang out. And so we'll have to do that in another place. Many of us will be at Climate Week in New York next week. We hope to see you there. We'll be at the Gin in Amsterdam coming up next month, at SoCap out here following that. So if you see us around and about, please come and say hello. And we hope you've learned something here and learned how to blend a little bit, and we'll look forward to seeing your deals in Impact Alpha. So thank you to all of you who've joined, and thank you to all of our great panelists and to the Impact Alpha team. We'll see you next time.
Thanks so much, David.
Thank you so much,
Nnamdi, everybody.
Bye-bye.